This is Logan Blackwood, reporting for International Desk. This morning, European stock markets opened, and they did not recover. The DAX, the CAC 40, the FTSE, all of them fell. Energy stocks swung violently. Government bond yields moved in ways that make finance ministers reach for the phone. And the trigger for all of it was not a banking collapse, not a political scandal, not a domestic recession. It was a strait, 21 miles wide, on the other side of the world. And it just reached inside every European economy and squeezed. In the next few minutes, I'm going to show you exactly how the Hormuz crisis jumped from the Persian Gulf to the trading floors of Frankfurt, Paris, and London. Why what you are seeing in the markets right now is not panic, but cold calculation. And what happens to ordinary Europeans if this does not stabilize fast? Because this stopped being a Middle East story. It is a European story now. And most people have not connected those dots yet. Let me give you a simple way to understand what is happening. Imagine a factory that depends entirely on one supplier, one source of a critical raw material, no backup, no alternative. And one morning, that supplier calls and says, "I may not be able to deliver this week." The factory does not shut down immediately, but the manager starts sweating. They call the bank. They slow production. They warn their clients. Now multiply that factory by 10,000 across an entire continent. That is Europe right now. The supplier is the Gulf, the raw material is energy, and the phone call was the Hormuz closure. Here is what happened. The Strait of Hormuz, the narrow choke point through which roughly 1/5 of the world's oil and a critical share of global LNG flows every single day, came under fresh restrictions. Iranian military and naval forces escalated their presence in the waterway, issuing warnings to commercial vessels and enforcing new passage rules that sent insurers and shipping operators into immediate crisis mode. Tanker operators started rerouting. Spot charter rates surged overnight, and Brent crude, the global oil benchmark, reacted the way it always does when supply confidence collapses. It climbed, fast, and it has not stopped. But the oil price was only the opening signal. What followed was a cascade. European energy companies, many of which had already rebuilt their entire supply strategy around LNG imports after the Russian gas crisis, suddenly found themselves staring at a second major supply disruption in 3 years. Hedging positions were blown, procurement teams scrambled, and equity markets, which had spent weeks carefully stabilizing, recalibrated everything in real time. But here is where it gets serious. Europe is not the Middle East. It does not border the Strait. It has no military presence in the Persian Gulf. And yet Europe may be the most exposed region on Earth to what happens there, because of decisions made years ago that created vulnerabilities nobody wanted to publicly acknowledge. When Russia invaded Ukraine and gas pipeline flows from Moscow dried up almost overnight, Europe made a critical pivot. It turned to LNG, liquefied natural gas, shipped by sea. It built new import terminals at record speed. It signed long-term deals with Qatar, the United States, and other Gulf producers. It paid enormous prices to do it. And it worked. Europe survived those winters. Governments stabilized. The immediate crisis passed. What Europe never fully solved was the underlying dependency. It traded one vulnerability, pipelines from Russia, for a different one, tankers from the Gulf. And those tankers passed through the Strait of Hormuz, every single one of them. Now let's look at the evidence. Here are the facts on the ground. Receipt number 1. European equity markets dropped sharply the day Hormuz restrictions were announced, and they have not recovered. The steepest falls came in energy-intensive sectors: manufacturing, chemicals, logistics, aviation. These are industries that run on predictable energy costs. The moment those costs become unpredictable, profit margins vanish and investment freezes. The market is not panicking, it is doing math, and the math right now is ugly. Receipt number 2. LNG spot prices in Europe jumped to levels not seen since the peak of the 2022 energy crisis. Several European utilities that had been running on comfortable reserve levels immediately activated emergency procurement protocols, meaning they are now buying energy on the open market at whatever price it demands, rather than at contracted rates. That cost difference is being absorbed somewhere, by the utility, by the government, or, most likely, by the consumer. Receipt number 3. The euro weakened against the dollar within hours of the escalation. This detail is significant and almost always overlooked. A weaker euro makes every dollar-denominated commodity more expensive for European buyers. Oil is priced in dollars. Gas contracts are often settled in dollars. When the currency falls and commodity prices rise at the same time, the inflationary pressure does not add, it multiplies. European central banks, which have spent 2 years carefully reining in inflation, are now watching a new inflationary shock assemble itself in real time. But here is where it gets worse. The European economy was not coming from a position of strength when this hit. Germany, the continent's industrial engine, has been drifting in and out of technical recession for over a year. Manufacturing output has been declining. Export figures have disappointed quarter after quarter. The German government has been threading the needle between fiscal discipline and industrial survival, with very little room for error. An energy price shock right now does not arrive into a healthy economy. It arrives into one that was already on one knee. France is managing political fragmentation and mounting budget pressure. Italy is carrying debt levels that require constant bond market confidence, and that confidence erodes the instant economic stability looks uncertain. And the smaller Eastern European economies, which are more energy-intensive and carry less financial cushion, are facing consequences that are not theoretical. They are immediate. What most people are missing is this. The Hormuz crisis does not need to last long to do serious damage. 3 to 4 weeks of elevated energy prices and supply uncertainty is enough to push Germany's manufacturing sector into emergency protocols. Enough to trigger another round of household energy bill increases across the continent. Enough to restart the inflation conversation that European central banks were finally beginning to put to rest. The damage does not come from the full disruption. It comes from the uncertainty. And uncertainty, once it enters an economic system, is extraordinarily difficult to remove. And this is where everything changes. The European Union now faces a policy dilemma with no clean exit. Intervene in energy markets, with subsidies, price caps, emergency state support, and blow out the fiscal discipline it has been struggling to rebuild since the pandemic. Do nothing, and watch inflation reaccelerate, consumer confidence crater, and growth forecasts for the coming year get revised sharply downward. There is no good option here. There is only a choice between different types of pain. And hovering above all of that is a diplomatic reality nobody wants to say out loud. Europe has almost no leverage over what happens in the Strait of Hormuz. It is not a party to the US-Iran confrontation. It cannot control Iranian decision-making. It cannot unilaterally reopen the waterway. Its influence is almost entirely indirect, running through Washington, through the remnants of the nuclear deal framework, through back channels that have been growing thinner for years. Europe is, in the most precise sense of the phrase, a bystander to a crisis that is actively destroying it. Let's talk about what this means at a practical level. For European energy bills, the direction is clear: upward. If Hormuz remains restricted for another 2 to 3 weeks, consumers across the continent will feel it before their next billing cycle. Governments will face immediate political pressure to intervene. Some will act, some cannot afford to. The result is a fractured patchwork of national responses at exactly the moment the continent needs coordinated action. For European industry, the damage starts at the margins and works its way inward. Steel, cement, chemicals, automotive, all of them see operating costs spike. Some slow production, some begin accelerating longer-term plans to relocate operations to cheaper-cost regions. The quiet question European industries have been asking for years, can we remain competitive in a permanently high energy cost environment, gets louder and more urgent with every week this crisis continues. For global trade, the Hormuz disruption functions as a tax on everything. It is not only European companies that absorb the cost. Every supply chain that touches the Gulf, and more of them do than most people realize, takes on additional expense and delay. That cost eventually reaches the end consumer everywhere. The world was not bracing for another inflationary event. It is getting one. For oil prices, the ceiling is now genuinely uncertain. Markets had settled into a relatively stable band. That band has broken. The worst-case scenario, a full closure, a military incident, a protracted standoff, could push crude to levels that trigger global recession concerns. Central banks that had finally stopped raising rates could find themselves facing an impossible combination: inflation rising, growth falling, and no effective tool to address both at once. For inflation globally, the risk is a second wave. The first wave, the one that followed COVID and the Ukraine war, was deeply painful. Governments and central banks spent enormous political and financial capital to bring it under control. A second wave, arriving before the recovery from the first is complete, would be categorically worse. Households that drew down savings to manage 2022 prices have less buffer now. Governments that ran deficits to protect consumers have less fiscal room. The system looks more stable than it actually is. If this is connecting dots you haven't seen anywhere else, Subscribe now. We cover the stories that link the Persian Gulf to your grocery bill, the geopolitical moves to your energy costs, the decisions made in Tehran and Washington to the life you are living right now. Subscribe, hit the bell. This story is not finished. Here is the bottom line. A crisis that started in a narrow strait between Oman and Iran has crossed an ocean and embedded itself inside European economies. It did not arrive with tanks or sanctions. It arrived through supply chains, through energy contracts, through the invisible financial systems that connect everything, systems that only become visible when one part of them breaks. Europe did not start this crisis. Europe cannot end it. But Europe is paying for it. That is what global interdependence actually means in practice. The vulnerabilities you build quietly in peacetime become your exposure brutally in a crisis. The real question now is how long this lasts. Whether the diplomatic channels still operating in the background can find a resolution before the damage becomes structural, before job losses begin in earnest, before inflation forces another round of rate decisions nobody wanted, before another European winter arrives on supply chains that are already strained to the limit. The markets are not being irrational. They are being honest. They are telling you exactly what the models show, that this is serious, that the downside scenarios are real, and that the distance between stability and crisis is narrower than most people are comfortable admitting. Stay watching, stay informed, because this might only be the beginning. This is Logan Blackwood for International Desk. Stay sharp.